Pakistan's horizon is on the verge of groundbreaking change, literally so. Just off its coast, geological surveys have discovered what could be one of the world's largest oil and gas reserves. It's a gateway to untapped wealth. Initial estimates suggest that the oil and gas reserves could transform Pakistan into a top-tier energy producer. If all goes to plan, within a decade, Pakistani waters will be dotted with offshore platforms, bringing in billions of dollars in revenues. The discovery comes at a crucial time. Pakistan is nearly broke. It currently imports roughly 85% of its crude oil and 30% of its natural gas from abroad, costing it billions of dollars every year in budget deficits. In response, the IMF imposed stringent fiscal restrictions, which have caused electricity prices to soar by 155% since 2021. As a result, fuel rationing has become the norm in many Pakistani industries, leading to a substantial drop in productivity levels. In its textile sector, export orders have declined by more than $1 billion due to fuel rationing. The struggle to meet energy needs has left Pakistan in a bad place. Foreign investment has nosedived, and living costs have jumped dramatically in recent years. In some cities, it now costs more to power a house than to rent it. Meanwhile, corruption, security, and bureaucratic inefficiency have put a lid on Pakistan's prospects. The discovery of oil and gas, however, could turn things around. It gives the country hope, even if that hope is at the bottom of the ocean. Special thanks to Uranium Royalty for sponsoring this episode. We'll go over their unique business model later. In January 2023, millions of Pakistanis woke to find their homes without electricity as the country faced its most extensive power outage in history. The fault was an irregular fluctuation in the national grid, but for many Pakistanis, the power outage was a stark warning. Decades of poor policymaking, widespread corruption, natural disasters, and a lack of long-term planning have hamstrung Islamabad's ability to balance the budget while keeping the lights on. But this wasn't always the case. At independence, Pakistan was one of the wealthiest countries in the world in terms of indigenous energy reserves. Supported by coal and natural gas reserves, Islamabad committed significant funds to the construction of hydroelectric dams and nuclear power plants in its first decade of independence. However, in the time following, Pakistan's population grew fivefold, and so did its needs. Circumstances deteriorated starting in the 1990s. The government couldn't keep up with rapid urbanization, and the existing infrastructure started breaking down. Islamabad reached out to energy brokers to stave off a power default, but in doing so, locked itself into a cycle of debt. Desperate to maintain political stability, Pakistan promised to subsidize energy companies to keep consumer prices at a fixed rate. It was a promise it couldn't deliver. So, when the government missed its subsidy payments, local energy companies could not maintain their infrastructure and started importing fuel. Today, Pakistan imports up to 30% of its natural gas and 85% of its crude oil from abroad, which costs the state $17.5 billion annually. This financial burden has come at the expense of public services, raising social unrest nationwide. To add fuel to the fire, the conflicts in Ukraine and Gaza have hiked energy prices. When adjusted for inflation and growing demand, Pakistan's annual import costs for oil and gas are expected to climb from $17.5 billion to $31 billion in the next 7 years. That is a jaw-dropping number. It will be 3 times larger than the current defense budget. Pakistan, unable to keep pace with mounting debt and skyrocketing prices, now has its back against the wall. Its industries are shutting down one at a time. The textile sector, for instance, which is responsible for 60% of its exports, has been unable to function for days at a time due to energy insecurity. Pakistani consumers are now facing reduced power availability but at higher costs. In the past 3 years alone, energy prices have surged so dramatically that many of Pakistan's 240 million citizens have been forced out of their homes and into the streets. Even by Pakistan's standards, it's the worst it's ever been. Islamabad's hope for economic revival has shot up. A lifeline has been thrown its way. In a recent geological survey, prospectors have identified 240 tentative sites that could potentially hold massive amounts of crude oil and natural gas, all well within Pakistan's waters. The million-dollar question now is whether this discovery is a game changer. Pakistani officials certainly think so. They're describing it as a blue water economy. While the precise location and size of the discovery remain undisclosed, official estimates place the blue water reserves as the 4th largest in the world. To put things in perspective, the US Energy Information Administration ranks Iran's oil reserves as the 3rd largest, with 209 billion barrels, and Canada's reserves as the 4th largest, with proven reserves amounting to 170 billion barrels. So Pakistan's estimated yield could be anywhere between these two. If made commercially viable, Islamabad's fortunes could change for the better. Its energy import bill would be reversed, freeing up billions of dollars to invest elsewhere. This, in turn, would allow Pakistan's foreign exchange reserves to recover after decades of depletion. The activity generated from an emerging blue water economy would bleed over into other sectors, leading to a boom in construction, logistics, and energy services. Meanwhile, building the necessary infrastructure in the Baluchistan and Sindh provinces would strengthen Islamabad's hold in the region and bring greater stability. China is the most likely to partner with Pakistan to tap into its reserves. It has the expertise, the funding, and the political will to pursue such an endeavor. China has already invested tens of billions of dollars in Pakistan's massive transport, energy, and infrastructure projects, better known as the China-Pakistan Economic Corridor. However, in recent years, Beijing has lost interest in the flagship project and has little to show for it. Even so, Pakistan's oil and gas discovery could renew Chinese interests, which would spur economic growth and bring back foreign investment to Pakistan. The timing for all this couldn't have come at a more crucial moment. With the West sanctioning Russian oil and gas companies and the Houthis rerouting maritime traffic in the Red Sea, global supply chains and energy markets are in flux. What's more, all this is happening while the international community has pledged to transition to renewables, a process in which natural gas is paramount. If Pakistan successfully develops its reserves, it could become a key player in the global energy market, giving the Saudis and Iranians more competition. International markets are desperate for new supply chains, and the Pakistanis could help fill that gap. The mass potential of its oil and gas discovery is not lost on Islamabad. Yet, upscaling its hydrocarbons has not been universally welcomed. In fact, there has been little welcome at all. Most major oil companies barely reacted to the news. On the contrary, recent years have seen a steady outflow of experts and investors, including oil giants such as Shell, Total Energies, and Eni. In June 2023, a state auction for 18 oil and gas blocks received a muted response from international bidders. Only 2 local companies, one private and one state-owned, made a bid for 3 blocks. The remaining 15 blocks failed to get even a single response. the fact that nobody is rushing to drill for Pakistani oil and gas is because of security or the lack thereof. For many businesses, the risk versus reward is just not worth it. In Pakistan, in areas where companies do business, substantial funding is needed to maintain security for employees and assets. The security provided by the Defense Ministry has been inadequate. This then drops profitability below the acceptable threshold for investment. And these security risks are real. In March 2024, 5 Chinese engineers were killed in an attack by insurgents in Pakistan's northeast. That same month, separatist forces attacked facilities near Gwadar, which hosts a port run by China. More recently, in October, a blast near Karachi airport killed 2 Chinese engineers. Even now, despite substantial boots on the ground in the troubled regions, pipelines and power stations continue to be attacked, and foreign workers continue to be taken hostage. It is these types of security risks that keep driving away potential investors. Another complication found in Pakistan is its constant political flip-flopping. With each new government voted into office or brought to power by a coup, prior political decisions are overturned without second thoughts. For instance, just months prior to the discovery, landlocked Turkmenistan expressed interest in using Pakistan's Gwadar port to export its domestic natural gas to global markets. Doing so would allow Turkmenistan to diversify away from the Russian and Iranian routes. A presumption in the negotiations was that Turkmen natural gas would underwrite Pakistan's energy crisis. Now, however, with the recent oil and gas discovery, the Turkmen deal has been left on the back burner. So, in addition to thriving corruption, poor infrastructure, and security risks, potential prospectors who do business in Pakistan must grapple with an ongoing political crisis that could see their assets nationalized overnight. For many, the risks simply outweigh the benefits. That being said, in the bigger picture, the initial resources needed to kickstart Pakistan's hydrocarbon industry are manageable. The upfront costs for the exploration phase, which will take 5 to 7 years, sit close to $5 billion. That's quite a gamble, but doable. China is not the only potential investor. Russia, Turkey, and even America could all pitch in. Turkey in particular is no stranger to high-risk, high-reward projects. Just recently, in October, the Turks dispatched their exploration fleet to Somalia's coast to map for offshore hydrocarbon reserves. Within 5 to 10 years, oil will flow there. Pakistan's situation is better than that of Somalia. So, to make its blue water reserves commercially viable, Islamabad needs to regain investors' confidence, negotiate suitable terms, and stick to them. The fact that its oil and gas deposits sit offshore may be a silver lining. Pakistan could build the necessary infrastructure along its coastline, confining the starting phase of its operations to small pockets and thereby reducing exposure to security threats. It would still be risky, but it would be safer than building facilities deep inside its dangerous hinterlands. Convincing investors of that and restoring their trust will be key. The next 7 years will be one of the most contentious and volatile periods in Pakistan's history. The energy import bill will nearly double, and Islamabad will have to find appropriate ways to keep the lights on during that time. Its oil and gas deposits may be a ticket out, but only if everything goes flawlessly. In geopolitics, it's one strike and you're out. Policymakers are not in the business of second chances. Of course, Pakistan's energy crisis is not unique. Markets worldwide are rushing to secure new avenues. In the decades ahead, oil and gas will eventually lose importance as we transition to renewable sources of energy. However, renewables are not producing enough. One problem is intermittency. Solar panels don't work at night, and wind turbines only spin about 35% of the time. Lawmakers, however, don't always do what's practical. Last year, Germany shut down its nuclear power plants, only for it to restart its coal facilities a year later. Meanwhile, in the Netherlands, some energy consumers are being charged for the renewable electricity they contribute to the grid. This isn't exactly the future that was promised. At the same time, innovations such as artificial intelligence, electric vehicles, and cryptocurrencies are driving up demand for power. If every car in the United States went electric, the state would need 20 to 50% more electricity nationwide. And that's just from electric vehicles alone. So, the transition to clean and reliable energy can't be accomplished by renewable technologies alone. The marketing for it is just not realistic. We should still pursue renewables, but other, more reliable technologies should also be explored. That's why half the world is now either building, planning, or interested in nuclear power. What we're seeing is nothing short of a nuclear renaissance. According to the experts at Uranium Royalty Corporation, one pellet of refined uranium, which is the size of your fingernail, packs as much power as 149 gallons of oil. Clearly, nuclear energy, being high in capacity and low in emission, could be part of the solution to today's energy crisis. Even tech giants are getting into it. Amazon, Google, and Microsoft are all investing billions of dollars in nuclear power, and they have to. By 2027, Nvidia is expected to ship 1.5 million AI server units annually, which will consume between 85 to 134 terawatt-hours per year. That is roughly the electricity consumption of a country like Belgium. So, this one company alone will push energy demand by one Belgium every year. Renewables are not cutting it. We need to reconsider nuclear power. Uranium Royalty is the first and only publicly traded pure-play royalty business in the uranium sector. See the ticker on screen. They don't own or operate uranium mines. Instead, they invest in them and secure a percentage of what is produced. Right now, they have 19 royalties across key regions, including Canada's Cigar Lake, one of the largest and highest grade uranium deposits in the world. With the growing need for clean and reliable energy, Uranium Royalty is ready for the coming surge in demand. And if you want to be part of the solution and maybe make a smart investment, click on the description to learn more. I've been your host Shirvan from Caspian Report. Thank you for your time and Sawal.